Hey everybody, welcome back. Now I want to spend a few minutes to talk about the Russian invasion of Ukraine, what to expect in the markets, the good news, the bad news, and what I'm personally doing. Alright, please give this video a thumbs up and let's dive on in. Alright, so what the market really doesn't like is uncertainty. Now after Bitcoin hit 69k, the Omicron virus got really bad, created economic uncertainty, and then we got more uncertainty about the possible contagion from the over-leveraged Chinese property market. And then in early 2022, the US Federal Reserve dominated the conversation. How many interest rate hikes are they going to be? When are they going to stop buying bonds? And every time the markets got a little bit of clarity, we saw a bit of a rally again. Right, so on January the 25th, we had the FOMC meeting. The US Fed didn't say anything that wasn't already priced into the markets. So that was a breath of fresh air. We got some level of short-term certainty on what to expect, and the prices began rallying. Now, the attack on Ukraine was largely priced into the markets by the time the attack actually happened, because the Americans have been openly warning everybody for months. Now, why were the Americans doing this? Was it to save our portfolios? No, it wasn't. The US government realized that firstly, keeping intelligence on what the Russians were up to secret worked out terribly in 2014 when the Russians had annexed Crimea. And number two, Putin was trying to keep Europe and the US divided, right, which was made easy by Biden's hasty withdrawal from Afghanistan last year, and the fact that Europe had a lot to lose by trying to punish Russia. So this time around, months in advance of the invasion plans, the US government were already onto the Russians, right? The CIA had intel all the way back since October last year. And the American strategy this time round, right, it wasn't to keep it secret, it was to let their allies across the world know early in an effort to build a coherent strategy to try and dissuade the Russians. So as a result, when Putin invaded on Feb the 24th, looking at the Bitcoin prices right now, the 4-hour chart, the market dumped around 7% from around 37k down to around 34 before quickly rebounding, right? Now, why rebounding? Well, because of perceived certainty, right? Information started flowing in about the scope of the attacks. Putin very quickly said that he didn't want to occupy Ukraine, and the sanctions so far, honestly, they've been pretty light as well. Right? Okay, so maybe things won't be so bad, and so the markets rebound as a result. But you see, this is where you've got to be a bit careful, right? There is a lot of uncertainty over the full extent of the sanctions that will be imposed. And this is bad because the kind of sanctions that's really going to get the Russians real good, right, are exactly the type of economic sanctions that's going to cause major problems for the Western economies as well. So that's why these sorts of sanctions, they're called the nuclear options, right? There's no way to impose them without basically burning yourself. Now, a good part of the Russian economy is oil and gas, right? There's a running joke that Russia is really a large gas station. And more than a third of natural gas in Europe comes from Russia, right? So if the EU, especially member states such as Germany and Italy, if they want to punish the Russian gas industry with sanctions, right, are they ready for some real hardship for their citizens? That's the question. Ex-Russian President Dmitry Medvedev was doing a bit of trolling on Twitter, right, poking the new German Chancellor who threatened to tear up the Nord Stream 2 gas pipeline. He was like, all right, you want to rip up this deal? No worries. Are your citizens ready to pay what essentially amounts to a 50% premium for gas? Now, what about ejecting Russia from the SWIFT banking system? Right now, this is a real example of one of these so-called nuclear options, right? It's going to cause a crisis in the Western banking system more immediately than Fortress Russia itself. You see, since 2014, after the West lobbed all of these sanctions on the Russians after their campaign in Crimea, Putin sought to essentially sanction-proof its economy, right? It's amassed huge currency reserves, it's cut spending and debt, it's reduced its exposure to the US dollar, it's diversified exports away from the West, right? Pursued self-sufficiency, and it's moved closer to China as well. Now, what about cutting off Russian access to semiconductor chips? Right? Well, yeah, this would gradually asphyxiate Russia's advanced industries. But look, they've got access to intermediate chips. That's going to help them get by for a while. They've got China as well. And importantly, they've got their own trump cards. For instance, Putin could cut off critical minerals that's needed to supply the West's own supply chains for semiconductor chips. Right, they can cause serious issues for the aerospace and armaments industry in the US and Europe by restricting supply of certain metals like titanium, palladium, and so forth. The US relies on these Russian titanium factories to build their fighter jets, rockets, missiles, submarines, helicopters, and other advanced stuff. Airbus in Europe is even more vulnerable, right? Half of its titanium sponge actually comes from Russia. If Putin controlled Ukraine, he'll have even more control over strategic minerals. The Kremlin could unleash an inflation shock as violent as the first oil crisis. So I think I've banged on enough about sanctions. The point I'm trying to make is there is great uncertainty over the nature of these sanctions, right? Light sanctions, they're going to let Russia get away and it's going to be good for the markets, right? While heavy sanctions can't really be made without damaging global supply chains and wrecking economic chaos. And this is going to be reflected in the markets. So be ready for some volatility, right? I think we're going to be in for some volatile times over the next few months. There's going to be some base level uncertainty over Ukraine for a while, I believe. So manage your risk and always be prepared. All right, now what about the other major macro factor that's affecting the markets, right? Namely the US Federal Reserve. Now, as I've talked about in past videos, I'm not terribly concerned, right? The US Fed has a history of saying one thing and doing another. Yellen, Bernanke, Greenspan. All right, historically, the US Fed has been happy to let inflation run for a while before they really swing that sledgehammer, like the Paul Volcker days in the 1980s. So honestly, I'm not terribly concerned about the US Fed just yet. So back to the charts. As I've talked about previously, I don't think the market cycle bull run is over. Certainly we are seeing lengthening cycles, but nothing too much to worry about. I haven't seen much on-chain data or data from derivatives markets to suggest that the party really is over. Although in the short term, right, things are not looking so great at the moment. Now, Bitcoin has some very strong support around the 30K level. On Binance, there's currently 7,000 Bitcoin worth of spot orders down to 28K and more than 4,500 Bitcoin, right, on Coinbase. So if you were thinking of buying the dip down in that range, well, you're in good company, right? You can bet that this is where smart money and institutions are going to be keen to swoop in. If we check out the altcoin dominance, it's really telling a story, right? Relatively strong. This kind of chart here is not the kind of chart we'd be seeing in a real bear market, right? In a real bear market, investors will be tripping over each other to try and protect their positions. They'll be running out of their risk on assets, and we'd essentially see the altcoin market pretty much get destroyed, right? Looking at the altcoin market index, aka Ethereum versus Bitcoin, look, we're seeing a bit of a pullback and a likely retest soon. But what we continue to see is a pattern that smart money, they're not willing to wait for the kind of major discounts that they get in a real bear market to rotate their capital from the safe haven assets like Bitcoin into the risk on assets, the altcoins such as Ethereum. They're willing to pay a premium. Right? And again, this is not the kind of sentiment you would see in a real bear market. All right, finally, with all of this said, what am I doing? Well, not much. Have I sold my crypto? Nope. In fact, I'm buying the dips, right? Cognizant that the market can and probably will go a bit lower before things get better. I'm just dollar cost averaging into the big long-term projects, right? So we're looking at Bitcoin, we're looking at Ethereum, we're looking at Cardano, ADA, right? Yes, I know some of you won't be with me on this one. Fair enough. Each to their own. Polkadot, Chainlink, right? What I consider to be the big boy projects that I'm willing to hold across entire bear markets if need be. And every time we get a dump, right, I am buying more and putting them straight into interest accounts, right? Saving them in interest accounts such as on crypto.com, Celsius, Nexo, and so on. Right? Feel free to use the links I've got in the descriptions down below if you want to sign up and get a deposit bonus. Overall, I think we are at the point where the market's pretty much dumped enough. Naive retail has largely been scared out of the market, right? They've ran out of Bitcoin to sell, and the kind of dumps that we are still seeing, it might be more reflective of whales playing games with each other more than anything. We're really reaching that bottom area where I think it's a great time to accumulate, and that's what I'm doing. All right, guys, please give this video a thumbs up if you found it useful. Let me know what you think down in the comments below. Take care, and look forward to seeing you in the next one.